Welcome to the Tax Talk podcast in episode 41, where we are looking at donations or taxation. I don't know about you, but every time I look at the news, it seems like a new tax has come out or there is a new tax increase being implemented on us. We just can't seem to catch a break these days. According to a recent report from Investment Executive, 8 out of 10 provinces in Canada now see individuals in the top income tax bracket facing tax rates in excess of 50%. That's ludicrous. In excess of 50%. Now, in Alberta, if you are making in excess of $355,000, that is going to expose you to the top tax rate of 48%. So we get a bit of a haircut here in Alberta, but in some of those other eastern provinces, I believe in BC too, you're getting up into 53%. Now, I know a lot of people will say, well, $355,000 is a lot in a year. Granted, that is a respectable amount of money to be bringing in on an annual basis. But with the increase due inflation, interest rates, etc., these income amounts aren't what they once were. If you've got a family that has a single income earner making 6 figures and you've got a couple of kids, you're living okay by every stretch of the word, but you're definitely not making it as far as you used to go. You go to the grocery store and that cart of groceries from Costco costs extremely more than what would have been seen even a few years ago. So what are some steps that we can take to maybe put some donations to our use to not only lower our tax liability on an annual basis, but to support a charity and organization that you value, preferably maybe in your local community, and then also to kind of take back some of that control that the government keeps pulling away from you with respect to your finances by these increased tax rates, varieties, whatever the case might be. So donations are an important tool that you can put into place if you're wanting to take back some of this control from the government. So I want to kind of look at 2 different streams here, one of which simply you're an employee, how you can use donations to better manage your finances throughout the year, and then looking at the individual that is drawing some type of remuneration through their private company. And then lastly, just kind of looking at a case study that identifies a couple that had currently been working as employees for third parties, and then they elect to incorporate themselves and then kind of provide some of these services via this corporation, and how they can use the donations to really draw down the amount of funds that are being paid to the government, and instead paying some of those funds into a donation of their choice instead. So, with respect to employees, fairly straightforward. There is a form that you can fill out. It is a T1213, and that is a request to reduce tax deductions at source. So, it's similar in some respects to that TD1 form that you fill out. It's just kind of the step further to that initial form that you would fill out typically when you started a new job. And what this is telling your employer is, I've got certain deductions that occur every year. They result in some sort of tax credit, and as a result of that, I don't want to have as much tax taken off my check on a regular basis, because what this ultimately leads to is a big tax refund. Now, I know a lot of people live for that big tax refund. You know, as soon as mid-February comes around each year, we've got people clamoring to come in here to get their tax returns done, and I know 10 out of 10 times it is the individual that knows that they're getting a refund. They want their cash back so they can go and do whatever it is that they're doing with it. While this can be okay in some respects, you have to look at it in another light. You've just given the government an interest-free loan for in excess of 12 months. That doesn't make a whole lot of sense. Instead, you could put together this form, send it off to CRA, and get them to approve it. So if you're consistently making donations personally, and you're an employee, you fill out this form, send it into CRA, and you indicate the amount of donations that you expect to make over the course of the year, and then they will provide you with what is called a letter of authority, which you then give to your employer. This letter will provide some instructions to the employer to enable them to decrease the amount of tax that they withhold on your regular paychecks. This will then allow you to have more cash in your pocket throughout the year, and you're then able to do something with that in the interim, as opposed to waiting for it once a year and not making any interest on that, not being able to do anything useful with it, just letting the government collect some interest and spend your dollars for you over the course of that period of time. So that is the process with which you would want to take if you were an employee, how to get that set up to reduce that tax amount on your ongoing paychecks. Now, if we swing over to donations by an individual, if they were operating as an employee or drawing some dividends via their own private corporation. So to me, this is a fairly straightforward, way of dealing with things. Typically we do tax previews for, our shareholder clients all the time, give them an idea as to, these are the wages and the dividends that you're planning to take out. This is the expected personal tax as a result of that. They're then able to set up, monthly payroll remittances or their quarterly tax installments if they're drawing out dividends. So if you are currently making, a steady donation payment, or if you're planning to, move down this route, you can speak with us and we're able to do a little bit of tax planning in advance and say, if you put X amount of dollars into whatever charity of your choice for the year, that is going to result in a reduction of tax of X amount of dollars, and then you can adjust your installments or your overall remittances accordingly. And then that way, similar with working for a third party, you have this money in your pocket and you're able to do something with that in the interim as opposed to loaning that to the government. So what are you going to do with this extra cash? So you need to obviously be aware of the fact that come tax season, you're not going to get a huge refund now. All things being equal, and if you do the planning correctly, you should just hit around that break-even point, which is what you want to do. You don't want to be owing a pile and then you've got to pay in some, installment interest, and you don't want the government to be owing you either, because then you are out those dollars all year long. So if you go ahead, take these steps, implement this plan, what do you do with this cash? First off, tax-free savings account. Probably one of the better options, especially if you're starting out investing. It's important to use up that room as best as possible. You can grow your, retirement funds or even some short-term funds without having to pay tax on any of that accrued income in there. Another one would be RRSPs. Again, very specific to the client. You know, if you are in the right income levels, it might make sense to be putting some money into an RSP. Again, we're able to do some planning with respect to that to make sure you are effectively putting the dollars into the RSP to not only get some benefit now, but to see some benefit down the road. Because there's no sense, you know, investing in RSPs if, you know, the deferral's negligible and there's really no hope of ever getting any permanent tax savings. You're just kind of kicking the tax down the road and not really seeing any reward out of it. And then another big one that I'm trying to kind of get a lot of my younger clients to focus on is that first home saving account that has recently come out. So important to have that account open. It needs to be open in order to create the contribution room on an annual basis, and then you're able to put money in there. It kind of combines some of the benefits of the tax-free savings account and the RSP put into one, and allows you to save up some funds to buy a house if that is possible, depending on where you're living in Canada these days. It can be easier said than done to break into that housing market if you are a first home buyer. But that is a surprisingly well put together you know, program that I think a lot of younger clients could take advantage of. So that is kind of the one side of it. The other side of it is you take that extra cash that you would have from your regular paycheck or your drawings, and then you just put it back into another charity. You're going to be stuck into this government refund position again, but then you're able to kind of keep supersizing the amount that you're putting into the charities in and around your neighborhood, drawing back further benefits and funds paid into the government and keeping them more local to organizations that, you know, you support and do good work with, you know, people and groups in your local area. So that would be one way to look at it. So it's important to strike a balance. You know, you don't get a dollar for dollar refund on your donations, so you need to kind of keep that in mind. You can't just donate away your entire tax liability, so it's important to understand the cash flow mechanisms of it. Otherwise, you're going to be, you know, contributing a whole pile into the donations and not kind of finding that sweet spot as far as cash flow goes. So in respect to the federal donation credit, you get 15% on the first $200 and then 29% on any additional amounts. If you have income in that top bracket, so up at 33% on the federal side, you would also receive a donation credit on the federal side of that 33%. And then here in Alberta, you get 60% on the first 200 and then 21% on any additional amounts in excess of that. So working with us here at Legacy Accounting, we can put together a tax preview for you and give you an idea as to, you know, what is an optimal amount of donations to put in to manage your tax liability while also maintaining a reasonable cash flow position. So that's what I kind of want to look at in this case study. And like I kind of mentioned before, a couple that previously worked for third parties providing services of whatever kind, you know, they have rolled this particular, you know, operation of theirs into a corporation. They're now working for themselves out of this company, contracting to whomever. Both husband and wife are, you know, active in the business, and they proceed to kind of go in a similar fashion, trying to get the same net family income to themselves as they saw initially when they were working for third parties. So initially, husband was making $100,000 and the wife was making $15,000. So what that translated into, I ran kind of a tax preview here myself to kind of get some of these numbers. So if husband was making $100,000, he'd have to pay into CPP and EI as he was working for a third party, and then he'd have some tax on that. So he was looking at a net take home of just over $74,000. The wife, in respect to that $15,000, again, she would have some CPP and EI. Based on that personal exemption amount, she didn't have any tax associated with that $15,000. So her net was just over $14,000. So as a family unit, they were looking at net income just over $88,000 at that point in time. So now, once they've moved in, they've incorporated, they're working out of their private corp. Husband's decided to take his remuneration as dividends. Wife elects to take hers as wages, and then they move forward accordingly. So as a result of this, they're able to split some of the income based on the fact that they are both putting in appropriate time. No one is, an idle or inactive individual in this. Both husband and wife are contributing, providing services, earning revenue for the company. So as a result, husband elects to take $70,000 as a draw or a dividend, and then the wife elects to take $35,000 of wages. So as the husband is taking the dividends, no CPP and EI, of course, so tax on those dividends would be a little over $8,200, resulting in net income of just shy of $62,000. Wife, $35,000 of gross wages, doesn't have to pay in any EI because it's through her private corp, has some CPP and some tax associated with that. So her net income is just shy of $30,000. So they're looking at net family income of about $91,000. So you'll kind of note that the overall net income has kind of decreased, or gross income has decreased for the family unit from 115 to 105, but that net income has stayed reasonably similar, and that is just kind of a result of the couple being able to get their income into the same bracket, as opposed to the husband being up into the top of the second bracket there, and then the wife being down in the first. So the only other thing to kind of include in this planning, and I've just kind of left it out for simplicity's sake, is once you move yourself to an incorporated position, you are going to have to remit equal portions of CPP into CRA. So kind of keep that in mind as a cash flow item. I typically like to look at the whole picture for my clients and say, eventually that cash has got to come out of that corporation one way or the other. And if it's coming to you, then we need to, address the fact that there are certain cash flow, outtakes that you want to be aware of when you're kind of doing this overall planning. So now let's take into consideration if the husband and wife kept their income amounts the same, so $70,000 of dividends for the husband, $35,000 of wages for the wife, so that same net income amount, no changes there as far as the amounts going to them, but now they are putting some amounts into charities. So for this particular scenario, I looked at a donation of $12,000. So what does that do to the tax situation? So prior to making any donations, the husband had to pay just over $8,200 in tax. Now he's making a donation of $12,000 and making a tax payment of just under $2,200. So this bumps the family's net income up to $97,000, which is up from $91,000. So yes, there's a bit of a bump there, but then we have to take into consideration the $12,000 that goes out as that donation. So they are then looking at net income of $85,000, which is very comparable to what they had seen as far as net income before they had incorporated. So what this kind of shows is through kind of the use of a small business corporation, getting some income that's a little bit more evenly distributed, and then putting some funds into a charity, you're able to maintain similar amounts of net income, pay less taxes, and then help out charities in your local area. And essentially what this ended up doing is, through the reduction of CPP premiums, EI premiums, and tax, this family was able to reduce the amount of funds going into the government by about $19,000. So to me, this is a good way to support local, and then to ensure that your hard-earned money is going to the organizations that you support, as opposed to into the government, where they seem to spend on everything but the items that you feel are important. Now, a couple other things to keep in mind. You know, if the husband elects to take dividends, yes, he's not paying into CPP. Something to consider. You know, obviously that's going to impact his retirement benefits down the road. Typically what I advise in this situation is you take a portion of your, dividend, and you are investing that into something that you see fit, in something that you're able to control. So whether that is, some sort of diversified mutual fund balance, maybe you are investing in some real property, building some sort of rental portfolio, things of that nature. There's numerous options that you can kind of put together to ensure that you've got some sort of retirement living, and you're not having to fall back on just government pensions down the road. And then the other item to obviously keep in mind is, if you do go incorporated, the ability to access EI is extremely limited. Most people understand this and are willing to take the jump into incorporation without having access to any employment insurance benefits. They're understanding that the payoff from being able to build your own business outweighs the potential risk of that business failing and you being out of work. So obviously something to take into consideration, but I think most business owners are fairly aware of that. So in conclusion, this is something that I've done for myself and my own family, where we've kind of looked at some ways to give more locally to some charities that we are, a big fan of. They do good work around us, and limit the amount of funds that we are then pushing into, the provincial and federal governments for them to, presumably waste away. If you're giving money into a charity, and for whatever reason that charity, isn't doing the work that they intended to do, or they promised that they would do, you have the ability then to pull those funds and put them somewhere else. You don't have that same option with the government. You're taxed, you send your money to Ottawa, and whether they waste it on pet project A, B, or C, you have no control over that. And, you might just want your local governments to fill the potholes, provincial government to build a hospital, and the federal government to, provide for some national defense. And if they aren't doing these things, your money isn't, being used in a manner that you see fit. So why not take some steps to put in a bit of planning into place? You're going to hit basically a similar net income amount if you do the planning correctly. And then you're able to support some local organizations and have a bit more say in how your dollars are used. I think if this was used on a broader scale across Canada, I think it would probably do some very good stuff for charities on a local basis, and it would probably squeeze off some of the funds going into the feds, which I always think is a good thing. So if this type of planning is of interest to you, feel free to touch base with me at the office in Red Deer. Phone number there is 403-343-7707. I'd be happy to sit down and chat with you and figure out a plan that might work best for you. Specifically, interested in helping anybody out there that has a corporation that's looking to do some planning like this. It's very easy to implement, very easy to kind of maintain going forward, and I think it has some real benefits, not only for you and your family, but for some of those local charities. So I think it's a win-win all the way around. Anyways, that is it for episode 41 of the Tax Talk podcast. As always, Jared here with you. Thanks again for tuning in. Take care, and we will talk soon.